Welcome back to Morning Trade Live. Jim Bianco's with us this morning to start with a little dissection of the past week, and then we'll talk about what's coming ahead over the next 5 days. He's a president of Bianco Research. Morning, Jim.
Good morning.
So if the yen carry trade did play a big role, how do we figure out what's left in it? I think so far I've described it more as like fuel onto the fire, which had already been burning with bad jobs and the false rotation in stocks. So tell me firstly kind of what role you think the yen is playing over the past week.
Oh, I think it's playing a significant role. I mean, anytime markets have violent moves like we saw in the last week, you have to ask yourself a basic question. Is this driven by fundamentals in economics, or is this driven by financial considerations? Fundamental economics could be COVID. Financial considerations could be the financial crisis of 2008 or the taper tantrum of 2013 or Volmageddon, if you're old enough to remember that, in 2018. Mm-hmm. I think this is a financial consideration driven by the yen carry trade. The catalyst for it was July 31st. And it wasn't the Fed meeting, it was the BOJ meeting where they surprisingly hiked interest rates. So if you're borrowing at 0% on a levered trade, and all of a sudden your funding costs unexpectedly go up, you start exiting the trade. Now, the problem is, if everybody asks how much of the trade has been unwound, I don't think that matters. I think what matters is on Thursday, Bank of Japan came out and said, got the memo, we're not going to be raising rates anymore. And that was almost like they blew a horn and said, okay, you can all get back in the trade because now you could go back and borrow at 25 basis points and lever up everything that you were previously levering up. And that's why we've seen markets respond. So the answer is a lot of it got unwound. We took a breath, and then we started getting right back into that trade since Thursday.
We're looking at a chart that I pulled from a Twitter thread of yours that's looking at how much the yen carry trade could profit relative to the S&P and the NASDAQ. How come you're looking at it with the Mexican peso?
Because that seems to be the more popular place to do the trade. If you're going to borrow in Japan at 0%, go buy the peso. Their 3-month T-bills are yielding nearly 11%.
Okay, so the
pocket that difference between 0 and 11%, and the currency is appreciated. And what that chart shows is the yen carry trade has, since the bottom in 2020, it has outperformed the NASDAQ 100. It has outperformed the S&P. And over the last 3 years, it's done better than Bitcoin. So why wouldn't anybody want to get into the big winner trade of the last 3 or 4 years? And that has been the yen carry trade. It's outperformed everything except NVIDIA at this point.
Okay, as far as the causality, though, Jim, goes, the Bank of Japan meeting was on the 31st, but the market was real calm for the 48 hours until the jobs number came out. We had a little bit of pop in the yen, but stocks were chilling for 48 hours.
Keep in mind that the yen carry trade, we all want to think that everybody's borrowing in Japan and, buying the Magnificent Seven stocks. They're buying in Japan and they're buying emerging markets is what they're doing because they're looking for that big fat yield. Those markets were problematic going into Friday. Okay. And our markets were problematic going into Friday. We had already gotten the 10-year note yield down under 4% before the payroll report on Friday. And so we saw some signs that this trade was being really unwound. And then we got the payroll report that was weaker than expected. And I think it's because of this, the yen carry trade, we had a completely outsized reaction to the payroll report. It was positive 114,000 jobs, a miss of 50,000, not negative 114,000 jobs. And that's the way the market responded to it. I might add, even today, the yield of the 10-year note is now higher than it was right before the payroll report came out. So the market has kind of calmed down and it's kind of returned back to those levels.
True. Well, we started pricing in basically extreme emergency cuts right after, as bonds are rallying and dollar got slammed. So that's going to exacerbate the carry trade too. The last point on this, Jim, instead of looking backward to look forward, but the last point looking backward is the NASDAQ peaked on July 10th, which was that CPI that came in light, the beginning of this whole rotation that fell on its face. So if we go back to then, that's really when the equity market started breaking down with the big tech stuff. How much of this is just attributable possibly to a blow-off top in AI valuations?
Oh, there's definitely some of that. But let's go back. You're right. When the CPI came out at negative 0.1%, June CPI that came out in July, that kicked off that gigantic rotation trade that we saw out of, big tech and into like the Russell 2000. In fact, by some measures, it's the largest rotation we've ever seen from big cap to small cap over any 3-week period back to the early 70s as far as the data that we have. And I think that really what it signaled was that negative CPI was, okay, now the Fed's going to cut. Now we're finally going to get the pivot that we've been talking about for 3 years, and the Fed's going to cut. Underscoring that if you look at the universe of how we look at markets, there's central bank policy, the Bank of Japan, and then there's the collective total of everything else. And it seems like central bank policy is 50% of what you should pay attention to, and the collective total of everything else is other 50%, because it was the last month, the two biggest things that drove markets was the CPI means the Fed's going to cut, the Bank of Japan surprised. That defines the last 5 or 6 weeks in the markets right now.
Okay. So looking forward now here, Jim, this week we do have CPI. That kind of brings us to an interesting spot, because if you go, okay, what would be great for the market? Light CPI. Well, that is what kicked off that failed rotation. So ultimately, that actually wasn't even that great last month. So what gets us out of the mess?
Well, that's a good question. I mean, what gets us out of the mess, I think, is a sense of stability in the market. As far as CPI goes, the street is at about 0.2 on headline CPI. The Cleveland Fed is at 0.3. If we get a number in that 0.2 to 0.3 range, then the year-over-year number still stays above 3%. I've argued that that's significant because for all the talk that we're in the last mile to 2%, we actually bottomed on CPI 14 months ago. And we're at that same low. We've like double bottomed if you look at a chart of it, CPI, but we're not making any progress towards getting the 2%. And if we get at 0.2, 0.3, we're still not going to be making any progress towards 2% now 15 months after the low. So I think that kind of number might elicit some kind of impatience. Oh yeah, the Fed's going to cut. But unless there's an upside surprise to CPI, an upside surprise to payrolls, or something upside surprise to retail sales later this week, unless you get something like that, the Fed's going to cut. But there might be some kind of impatience that are built into that. The problem with a negative number or a bad CPI report is you might have another reaction like we had off the payroll report, that it's not about cheap money, it's about the economy falling off a cliff, and you could have a bad reaction there. So I'd say a 0.2, 0.3, a 0.2 number would be the best for the market. 0.3, a little less so, and if we got a 0.4, that would be very bad.
Our sweet spot is getting to be a thinner needle to thread, it seems like, now that bad data has been obviously bad for markets. So it puts us in a pretty tough spot. Jim, what about the folks who are arguing that components of CPI, especially on housing, are stale and, yada, yada, that stuff shouldn't bother the Fed? I mean, does it matter if the Fed does care and does actually use, the current basket of calculations?
Yeah, I mean, that's the parlor game we all play. We all dissect the CPI 6 ways to Sunday, and you've got those that want the Fed to cut that says, throw out all the high numbers, and guess what? CPI is low. And you got those that don't want the Fed to cut and say, throw out all the low numbers, and CPI is high. The Fed's even played this game with their super core metric that they've invented as well, too. But I think if you look at the bigger picture with CPI and you look at what's called the base effect, in other words, look at the numbers that we had last year that we're going to drop off this year on the year-over-year calculations, I think that the CPI numbers and inflation in general is going to kind of come in and slow down its year-over-year. Whatever it's at right now, it will be at for the next several months. And again, like I said, that's 3%. And that is, Jay Powell would tell you in a vacuum that if the CPI settled down at 3%, that's unacceptable. They needed it 2 or lower, that is too high of a number. Yeah. So I think that that's really what we're going to have to start looking at is the bigger picture. Is it making any progress towards 2%? As I said before, it stopped in May and June of last year. It bottomed at 3%. It's at 3% now. If we get a consensus number on Wednesday, it will still be at 3%. It has not made any progress. And then the question is that acceptable? I don't think it is to Jay Powell. I think to other members of the Fed, like Chicago Fed President Austin Goolsbee, that is acceptable to them, and that's going to be the dilemma that the Fed's going to have to deal with.
Okay, well said. As it's definitely a tricky spot for them right now, and the market wanting a lot from them. So, Jim, what do we do here for the next couple of weeks, then, or at least through this week? What do you like? Is it rotation trade? Is it tech trade? Is it just bonds, gold? What do you like right now?
I think the bond market's a little overdone in terms of the rally that it's had, and it's expecting a little bit more than it should. If you look at the Fed Fund futures, just as we went on air, I was looking at it, is literally 50-50 on whether the Fed will cut 25 or 50 basis points.
Right.
So the market is still holding out hope that there will be an outsized move or maybe an intermediate move between now and September 18th. I think we're getting 25, unless, of course, the data surprises. So the market has still got a little bit too much hopium priced in that we're going to get more aggressive Fed. That's going to have to come out of the market. So I wouldn't be surprised if we do see the 10-year yield, go back above 4%. It was there 2 days ago, or Thursday to be exact. But this time, go back above it and stay above it. And if we see the 2-year yield start to, go back to 4.25 or somewhere in that range, and that might be a little concerning for the market, especially if we get at least a consensus CPI report as we move forward from here.
All right. Jim, thanks a lot. Great stuff. Appreciate you being here this morning.
Thank you.
Yes, sir. Jim Bianco, president at Bianco Research. All right. Looking for sustained impact of the carry trade unwinding from one of the best returns across assets over the past year. Compelling chart there from Jim. I think a good discussion, too, on how the dominoes got falling.